Welcome, my name is Jeremy. This is Neko Nation Japan. We're talking today, one of my favorite subjects, dividend paying stocks. And what is a stock? A stock is part ownership that anybody could buy in a corporation. Now, there's a few caveats to that. When you buy a share, you have partial rights to the assets and earnings of a company or a corporation. But you have limited legal rights with, if that company goes out of business, they can't, state or government can't go after you and then try to cover those debts, which is always a good thing because you never know. Next, companies issue stock in order to raise funds, increase capital or equity in this company. But they can also use profits they earn in order to do a few things. 4 different things I like. First, they can expand the company, making it larger, hopefully more profitable. Next, we can use that money for debt reduction. Then, share repurchases, always a good thing, increases the EPS or earnings per share of the shares you already own. And lastly, my favorite, they can issue a dividend. Now, whether that is a cash dividend, paying you out a certain percentage per share over maybe span of every monthly, quarterly, or yearly dividends. I like myself either monthly or quarterly dividends, but some places such as Japan don't do any quarterly dividends. They only do yearly, which is kind of not my favorite. That's why I don't own any stocks here in Japan. All my stocks are American-based companies. Next, so in Japan, in any corporation or shareholding corporation, when they sell shares, if that share has a dividend associated with it, it's paid out yearly. Now, that is not exactly what I like, but because I like to do dividend reinvestment plans. So every time, every quarter rolls around, my stocks buy a little bit more of each company. One of my holdings, Coca-Cola, every quarterly buys a little more and a little more Coca-Cola, so it gets larger and larger and larger every time that dividend rolls around. This, I think, is the most beneficial plan. Anyone, and especially if you're young, like myself, get more and more money as time goes on. If you own shares in a particular company, such as Coca-Cola or Johnson & Johnson, large companies that I like to invest in, what happens if they earn a profit? What can they do with it? First, they can use it towards expansion. Maybe they're expanding into new product lines, new developments, new R&D. Then, maybe they want to use that to reduce their debt in a particular location. Now, why would they reduce the debt? Because it makes their balance sheet look much better. Also, they can use that for share repurchasing and then drive up the EPS of that stock, which is always nice too. This, if the company is undervalued according to the board, is usually always a smart move. Next, and my favorite, dividends. All the shares I own pay out dividends. Now, these dividends can be paid in 2 ways. First, we have a cash dividend. Now, this cash dividend can be paid over monthly, quarterly, or annually. I favor quarterly or monthly. Here in Japan, only dividend-paying stocks are paid annually. I don't particularly like it. That's why I'm not invested in any stocks here in Japan. All my stocks are stateside in America. But I always like quarterly, and I look at those companies just to see how they're doing. Now, you could also have a share issuing dividend. So they'll give you shares based on how many shares you already have. Maybe they'll give you half a share per share you have. Depending on how it is, that could be a lot of shares. So in order to explain dividends to you, I need to go through some of the basics first. First, what is a share? What is a shareholder? A share is the percentage of the company given out by the corporation upon its initial public offering, or maybe they have a later declaration of stock. But a shareholder is any person, company, or institution that owns at least one share of another company or institution. Then it's called a shareholder. Next, what is a dividend? Now, I am complete and utterly a dividend investor. I invest in a dividend-paying company of large cap size. We'll get into what cap is later. But this dividend is a portion of the company profits that is distributed based off of how many eligible shareholders there are. So if you are an eligible shareholder and you have a large portion of stock, you get a large portion of dividend during that dividend payout. Now, if it is a cash dividend, you could have a large sum of cash delivered to you. Now, it's usually in all good companies, between 1 and 3 to 4%. This is called a healthy, stable, large cap company. That's about average what you'll find. Sometimes if you look at the higher percentage, it's not a good scene. They could be doing that just in order to get people to buy their stock, and you got to check to make sure that is actually sustainable in that dividend payout ratio, which we'll get into a little bit. But this can also be paid in stock dividends. So they give you more shares based off how many shares you already own, which is rather nice, I might add. First date you need to pay attention to, the declaration date. That's the date at which a company's board of directors announces it's going to have an upcoming dividend payout. Then that dividend pay date is the date as declared the dividend is scheduled to be paid, the payment date, and you have the record date. This date is the company uses to determine its shareholders or holders of record. Now, you will only get the dividend if you own that share, or at least however many shares you have, before that date of record. Now, after that date of record, that share will be sold, but it'll be your ex-dividend date. That'll be after that date. It does not include the dividend that's coming up. So you will not receive that specific dividend. Now, we also have what's called a one-time dividend payout. This usually is a larger sum of money if the company has particularly had a very good quarter or very good year and it wants to reward you as being a shareholder. It gives you a percentage of the profits, maybe a few extra dollars a year or maybe even more, depending on how many shares you have. We know the basics of a stock. Now, we got to do the basics of a dividend. A dividend is paid to eligible shareholders. What is a shareholder, you might ask? A shareholder is any person, company, or institution that owns at least one share in a company. So all of your shareholders then may receive a dividend. What is a dividend? Dividend is a portion of the profit that the company decides, yes, we have extra profits for this quarter or year, and it says we will pay that out to our eligible shareholders. Now those shareholders receive maybe a few percentage points, a few dollars a year, which is not bad. This could be between 1 and 3% for a healthy dividend paying stock. There's two types of dividends paid out from a company. First, we have the cash dividend, paid out percentage-wise in your per share basis. Then we have a stock dividend. This stock dividend is given to you based off how many shares you already have of that company. So it may say 0.1% of a share per share you already have. Now, we have a special dividend called a one-time dividend. This one-time dividend is usually a little bit larger than your quarterly or annually dividend, but always more money is welcome. This can be also paid in cash or additional shares. Next, and most important thing about dividend investing, which I think a lot of people overlook the power of this method, is the DRIP program or dividend reinvestment plan. Now, you can either get a DRIP from the particular company you're buying stock from, or like with me, I have Fidelity Investments and I use their dividend reinvestment program built in. All you have to do is check a little box and they automatically buy you more shares based off the dividend you receive. Now, you can receive full shares or fractional shares, always good. So, in this example, we have a stock, $25 stock. Now this stock has a pretty hefty dividend of 50 cents per share. It's a little over exaggerated for our example, but you'll see the power very quickly. So we want 100 shares of this stock, paying a total of $2,500. Then, after that, you receive first quarter $50 dividend payment. Not too shabby. We use that $50 to buy 2 more shares of stock. Then we have 102 shares of stock. And next, we get another dollar out of that. So we get $51. Now, every time you're buying shares, both either fractional or that, so we end up with 204 shares of stock. With a little left over, some fractional shares, but that's okay, we ignore them for this example. So every quarter you receive more and more shares, and you get more and more dividend payback. And that exponentially growth, the most powerful force in the universe is exponential growth. And that's why I use this method in order to make my money grow. So keep your money and watch it grow. What I always say. There's many things a company can do with its money and profits. It could pay out a dividend or reduce debt or those kind of things. Now, my favorite, dividends. Not all companies pay out dividends. Many companies do not pay dividends. They're either too small, don't have enough profit to say, okay, we're done growing for most part. We want to pay out a nice dividend to keep our shareholders happy. Now, a lot of companies don't pay the dividends, but even the companies that do are not guaranteed to keep paying dividends. Now, there is a lot of pressure to maintain and even raise dividends, but if they don't have the earnings per share and a good balance sheet to allow for that, sometimes they have to take out debt in order to do that, which is not always good for a company. Now, this companies that do pay dividends, they may pay dividends for a very long time, could always cancel, reduce, or raise the dividend. It's kind of a gambit as far as that goes. I like to buy dividend-paying stocks and hold it for as long as possible and just rake into those dividends, reinvest it, and get more and more shares of this particular company that I believe in, has a good value basis, and should be a good company for many years to come. Now, many companies like Microsoft went a very long time without paying a dividend. They were in business for 17 years before they decided to start paying out a dividend. At which point, I looked at that company and said, not too bad. So I bought myself some shares of Microsoft, and it's been one of my current and very good stocks going for me. Now, many companies like Coca-Cola have been paying out quarterly dividends since 1920. Now, these companies, I also own good shares in Coca-Cola. They've been paying out dividend for a very long time, and they have a very lot of pressure to maintain that dividend and make it slowly rise over time. Now, is the particular stock price important to me? Not so much, except on my initial buy-in to that company. Once I buy in at a decent amount of shares, I just reinvest that dividend. And I look at that company in the stock price and say, is this a good value from what I first paid for it? If it goes down, and I feel it goes down enough, I'll probably buy more shares of that company if it maintains that basic good balance sheet. So, some important things to take in mind. It's easy to get kind of elated with amounts, and some companies have huge dividend payouts, but you always got to be very wary of those dividends. They could either be so high that that company needs to draw more debt in order to maintain it, or they're just a tactic where the company bumps up the dividends in order to make people come in and buy that stock. And then what do you have? you have an overpriced, underperforming stock if it starts to cut or eliminate that dividend. Now, what is a good range of dividend yields? Historically, over the last 20 years, it's between 1.7 and about 3.2% is the average for the S&P 500 dividend-paying stocks. Now, that's a good range to go with. With dividend investing, you can achieve about that. Over the last 20 years, on the S&P 500, biggest companies in the world, or at least in the United States, the dividend yield is between 1.1% and 3.2%. Now, these are massive companies, are very stable and good for the long term. Look at those companies and decide, what kind of dividends do they pay out? What kind of yields? What would be the best one for you? You also have to look at what kind of company will maintain in the long term. If it's, say, Walmart, very successful company, but they've been hit very hard by Amazon. What about their future prospects? If they don't change anything, which I'm not seeing them now, their earnings are lower and lower every time. What's going to happen? Their company may be drastically hurt. Dividends cut. Who knows? With a lot of these companies, with these super high dividend payouts, they have usually very limited future growth. You want one with a marginal payout, maybe 1 to 3%, which is the average in the S&P 500. Now, these are healthy, mature companies that have always maintained these nice, reasonable dividend payouts. Now, if you buy in these companies, we can use this exponential growth formula that I looked at earlier, and you can get massive stakes and large dividend pay, keep on returning you every quarter in order to receive more and more dividend income. Always good. Now, this large yields, another great advantage for your dividend paying companies. These companies such as Coca-Cola has paid out dividends since 1920. They have a few one-time payment dividends, such as in 2016, they had a dividend payout of $1.40 per share. Now, these companies, very large, are under a lot of pressure to maintain and grow those dividends. So they tend to do much more smart moves because they look at the dividends over the long term. These companies, such as Coca-Cola, are working very hard to not disappoint shareholders and let down that dividend or cut the dividend. So what do they need to do? They need to decrease their earnings per share, maintain good company and customer relations, and look where could this opportunities they come from and make more money in their given market. 4 most important factors when dividend investing. In order to take part in the dividend reinvestments, what do you need? First, you need an initial investment in a company. It could be as little as $100 to buy shares, or as big as you want to put in it. Then you have to take advantage of their earnings, aka dividends. So every quarterly you reinvest those dividends earnings into more shares. And the last thing, time. Give it as long as possible. With a healthy, stable company, you'll make more money than you could possibly imagine. So, in order to take full advantage of compounding interest, what do you need? First, you need money to make an initial investment. Small sum, larger the better. But after your initial investment, you need to take advantage of the earnings or dividends to reinvest in more and more shares of that stock you put your initial investment in. So, then, last thing you need, time. The more time you give it, the better. Time and time again, give it time. That compounding interest goes faster and faster and faster, up and up. So, first thing, initial investment. Next, earnings, taking care of that earnings or dividends. Then you reinvest those earnings into more shares. And then give it time, and you'll see your money and watch it grow. So where do you start? After going through all my video and looking into more information, which I completely encourage you to do, where do you start? First, you'll need to get yourself a brokerage account. I like and use Fidelity. There are many others, such as E-Trade or Robinhood. A very nice app, I've heard. Low, very low, if not no, trading costs. If you're a starting investor, maybe that's the place for you to go. Now, what else do you need? You need tools. What kind of tools do you need? You need a nice online database to look through and narrow down your stocks. I look for dividend-paying stocks. I like to use Yahoo Finance and just Google search in order to find those little gems in the large companies you find. I look at large cap stocks, pays dividend, stable for a very long time. What can be better than that? Another very important aspect of dividend investing, taxes. You need to make sure and keep track of how much dividends you're receiving, because that is taxable income. Mind you, that income is taxed quite a bit less. And if you use it to repurchase shares, you don't have to pay any income tax on it because you don't actually receive the money. It's automatically used to repurchase shares. Now, if you receive dividend payouts in the form of cash, you need to keep track of that. And a lot of these online brokerages have many different ways in order to help you with this. But please keep track of all of your dividend payouts and received in order to give them to your tax man and make sure you are completely compliant within the law. But it's definitely important to keep in mind that within any investment there is always risks. With large companies, it's very little risk, or less risk than your smaller companies, but still, they have a chance to go down or out of business in a snap. A company that pays a long-term, consistent, nice dividend payout is usually financially healthy firm that generates consistent cash flow. Now, what's better than cash? Cash in your pocket. This is Neko Nation Japan, Jeremy signing off, and hope to you keep your money and watch it grow. Sayonara. Thank you for coming to Neko Nation Japan. And today we have your word of the day. The Japanese phrase today is Ata no Matsuri. Matsuri is a kind of general festival they have a lot here in Japan. Ata no Matsuri means to be too late to the Matsuri festival. So in the business world we have this phrase, to be too late any use, or a day late and a dollar short in America. So Ata no Matsuri means to be too late to be any use. Thank you for stopping by Neko Nation Japan. I hope you have an awesome day. Keep your money and watch it grow. Sayonara.